All right, it was Tuesday, February 3rd, 2026, and if you opened your charts this morning, you probably had that split-second feeling like the market just tried to punch you in the stomach. Overnight, we got another violent price smash. Silver tagged a low near $71 an ounce, and you could feel the forced selling, the kind that doesn't look like normal investors changing their minds, but like positions getting liquidated because somebody, somewhere, hit a limit. Gold also flushed hard, down to about $4,399 before clawing its way back. And now, as I'm recording this pre-market, silver has rebounded from $71 to around $83. That's roughly a 17% bounce off the lows, massive by any normal standard. Gold has recovered about $250 of an approximate $450 intraday dump. From the low, gold's up around 7%, silver's up around 15%, and we're still waiting for the New York cash session to really tell us what's real and what's just a reflex. Now here's the part I want you to focus on, because this didn't come out of nowhere. In my previous videos, I laid out scenarios for silver using Bitcoin as a leading indicator. And I did that for a reason. When risk sentiment flips hard, crypto, especially Bitcoin, often moves first. It's not because it's smarter, it's because it's fast, liquid, and it trades around the clock. So the signal shows up there before it bleeds into commodities. My line in the sand was simple. Watch where Bitcoin closes the weekend. I said if it closed below the 80-82K area, expect that selling pressure to spread. And it didn't just close weak, it closed around $76,000 with an intraday low near $74,500. I warned that a test of $74,000 or below would confirm real weakness. That level mattered because it would flip the "this is just noise" narrative into "this is risk off and it's contagious." And then it happened. The spillover selling arrived exactly the way that setup implied. Silver got clipped all the way down to $71. Then we got the relief bounce, a hard snapback back toward $83. Now we're at the moment of truth. Does the bounce hold once real volume shows up, or do we roll right over and go back down to retest the lows? Before we go further, I read the comments from yesterday's upload, Sunday, February 1st, 2026, and I appreciate you, not because I need the validation, but because it's obvious a lot of you are actually using the framework. Some of you are preparing mentally for another leg down. Others are staying anchored to the long-term macro thesis. And I want to say this clearly, that split doesn't mean people are lost. It means people are thinking. It means you're building your own plan instead of borrowing someone else's panic. And that's the culture here. We don't do fear, we don't do greed, we don't do Netflix-style scripted market drama where everything magically resolves in 10 minutes. These are real markets with real leverage and real consequences. Quick and serious reminder, especially for anyone new. I do not sell signals, courses, mentorships, or paid groups. If someone is pretending to be me and asking you for money, it's a scam. Block them immediately. My only presence is on YouTube as Asian Money Guy. That's it. No assistance, no VIP, no private DMs asking for payment. Protect yourself. Now let's talk about the data as of this pre-market window. Onshore pricing is still showing a meaningful premium versus the Western paper price. Shanghai spot is around $11.99, SHF futures around $11.42, while Western spot is around $83.47, and futures are basically matching. The premium being quoted is roughly $18.52, which puts it near 22%. That's down from the roughly 43% premium we saw over the weekend of January 31st, February 1st. But 23% is still not normal. It's still a sign that physical tightness isn't just a rumor. It's visible in the spread. And then you zoom out and you see what's really messing with people's heads. In about 3 trading days, basically since Thursday, January 29th, 2026, you've got this narrative flying around that roughly $10 trillion in value has been wiped out across major asset buckets. Gold off about 20% from peak, silver down close to 40% from highs, moves that look less like safe havens and more like high beta speculation. It feels like the world is watching safe assets trade like meme coins. A lot of people are calling this the Kevin Walsh Fed chair sell-off, and whatever you think about the politics of it, the market behavior is what matters. This doesn't look like a normal drawdown. It looks like stress. And here's why the stress argument is so important. If this were simply gold is no longer wanted, you'd expect central banks to be dumping. That isn't what's being signaled. You'd expect big holders like Tether to be forced into sales if the story was everyone is deleveraging everything. But the bigger tell is this. The fundamental backdrop didn't suddenly become sunshine and rainbows since Thursday. The US didn't magically solve its debt trajectory. There wasn't some sudden miracle policy that erased deficits overnight. In fact, the fiscal story looks worse. There's still political dysfunction, and the government shutdown narrative is still hanging around because spending fights aren't resolved. So why would gold puke this hard? The cleanest answer is the simplest one. Somebody needs liquidity. And when you need liquidity in a hurry, you don't sell what you want to sell, you sell what you can sell. In a real margin call event, the margin clerk doesn't care about your macro thesis, they care about cash. Gold and silver are liquid, and for many funds, they're profitable positions. That makes them the first piggy bank to get smashed when the phone rings. So the way gold is sliding while equity futures sag, Bitcoin is weak, yields are dropping, and the dollar starts to firm up, that combination is not normal price discovery. That's stress behavior. That's what it looks like when something behind the curtain is tightening. Now let's address the part people argue about the most, paper versus physical. Here's what's being reported and observed across multiple regions. In Singapore and Australia, you're hearing about retail buyers queuing up, and not for cheap paper exposure, for physical metal. In parts of onshore Asia, supply is scarce and premiums are wide. In several European dealer networks, offers on silver get pulled when volatility goes vertical. That's what happens when dealers don't want to promise delivery into chaos, and it's not subtle. One of the loudest data points in the story is pricing on JD.com, where silver is being shown around $163.35 per ounce today, while the Western paper reference is sitting near $83. That's about a 95% premium. And yes, silver is still being described as backwardated, which, in plain English, is the market screaming that near-term delivery is scarcer than future delivery. You can't fix a physical shortage by pushing paper price down for a few sessions. You can scare weak hands. You can trigger stop-loss cascades. You can force leveraged products to unwind. But you can't conjure bars out of thin air. That's why the paper manipulation conversation keeps resurfacing, not because it's a fun conspiracy, but because the market structure makes it possible for paper volume to bully price in the short term, even while physical tightness grows underneath. And you can see how the mechanics would work. Heavy selling during thin overnight hours, sudden dumps that look like they're designed to gap levels, then wash trading behavior during the US day that pins price while derivatives unwind. When volatility spikes, leveraged ETFs and derivatives products become accelerants. They don't cause the move alone, but they amplify it once the liquidation cycle starts. The result is a flush through stops that looks like everyone changed their mind, when it may actually be forced positioning. Meanwhile, the physical indicators aren't acting like demand collapsed. Onshore vault readings are being described as stable, premiums are still elevated, and the message becomes, paper looks like it's breaking, physical does not. So what happens next? I'm watching two clean scenarios as the US session opens. If the selling resumes and we fail to hold this bounce, silver can absolutely retest $71, and if we lose that, you could see another leg lower. The bounce could be nothing more than a relief rally. Also, margin changes can matter here. If additional collateral requirements hit and traders can't post it, forced liquidation can restart, even if fundamentals didn't change. But if the bounce holds, if we stabilize above the rebound zone and buyers show up with conviction, silver can reclaim higher levels fast. That's the nature of this kind of volatility. Sharp drops are designed to trigger fear, and fear is how markets shake out impatient money. If the bounce builds, you can easily see the price probe back toward the high 80s range quickly because the snapback momentum is already there. And the macro argument hasn't disappeared. Debt and deficits didn't vanish, refinancing pressure didn't vanish, geopolitical uncertainty didn't vanish. Volatility does not automatically equal a trend reversal. Sometimes it's just the market violently repricing leverage. So here's what I'm watching in real time once the day truly gets moving. I'm watching whether this 71.83 rebound holds or whether it fails and we slide back toward the lows. I'm watching whether Bitcoin stabilizes in the mid-70s or breaks again because that's the risk sentiment tell. I'm watching whether equities stabilize or gap down because metals often get dragged early in deflationary shock before they decouple later. I'm watching whether the onshore premium holds in the low 20s or compresses hard, because a compression toward 10% or lower would hint physical demand is cooling, while a rebound toward 30-40% would suggest physical is still overpowering paper pressure. And yes, I'm watching headlines too. Banking stress, shutdown resolution, and Iran tensions can all move markets violently in either direction, especially when positioning is fragile and liquidity is thin. Where does this leave you? It leaves you with a market that is screaming one message in paper and a different message in physical. It leaves you with a session open that can confirm whether $71 was the low or whether that was just the first trap door, and it leaves you with one uncomfortable truth. Leverage in conditions like this is exceptionally dangerous because you can be right and still get wiped out by timing. So stay sharp, don't trade headlines, watch the levels, watch the premium, watch whether the bounce is defended when the volume arrives, and above all, think for yourself. This is real risk, not a scripted story. If this kind of real-time framework helps you cut through the noise, make sure you subscribe. And if you want, drop Asian Money Guy in the comments so I know you're part of the group that values clarity over hype. We'll see what the opening bell decides. Stay disciplined and stay alert.